Welcome to the Fear and Greed Daily Interview. I'm Sean Aylmer. This is a tough time for startups and investors alike. Global markets have had their worst first half on record, and it's particularly challenging for tech stocks. Just look at the NASDAQ. It lost $5.4 trillion US dollars, that's with a T, in value since the start of the year. Locally, we're seeing startups, including some of the more established players, laying off staff. These are businesses that were growing just 12 months ago. Dr Michelle Deaker is one of Australia's top venture capitalists, the founding partner and managing director of OneVentures, which has helped create 5 NASDAQ and 3 ASX-listed companies, delivering returns to investors of more than $1 billion. I wanted to get her take on where we're heading, what the market volatility means for the startup scene, and what it means for those investing in it. Remember, this is general information only. You should speak to a professional advisor before making investment decisions. Michelle, welcome to Fear and Greed.
Thanks, Sean. Thank you for having me.
So, from your perspective, how would you describe the last 6 months in equities?
Yeah, look, obviously, there's been a massive shift, and we've been through a very unusual period of history where there was very low yield environment. The world looked for how they could save themselves during the pandemic in many respects, and a lot of people turned to technology. And we realized that technology could drive productivity. And as a result of that, a lot of tech stocks obviously got the tailwind of that. And really, we saw huge growth, phenomenal growth in a number of these companies. But step into this year, the war in Ukraine, the energy crisis, the fact that interest rates were going to rise and we were going to see inflation for the first time as the big global governments decided that they needed to pull back on that monetary stimulus, and the only way to take money out of the economy was with inflation. And what really has happened is that the world has started to reprice risk. So we've had that volatility and we've had inflation, and now we're seeing a repricing of risk because capital that was before looking for yield and willing to take on more risk to find it is now able to find and shift into areas where it's lower risk to get yield. And so we've seen a pull out of the capital markets as well.
Okay, so what impact does this have on the venture capital space? Because that is a high-risk space.
It is. And, I think, as I said, risk wasn't being properly priced in the past, and now it is being properly priced. So we've seen valuations come off, and we're also starting to see what we would call more structured deals being done by venture capitalists. What that means is a change in the types of terms. Venture capitalists may, for example, ask that their investment is preferred in structure to the ordinary shareholders in the company, or that their investment might receive a multiple before ordinary shareholders participate in future profits of the business. So we're starting to see much more structured deals being done, but we've also seen in terms of valuations what we would call a reversion to the mean. So last year we saw some valuations for companies anywhere between 10 and 30 times annual recurring revenue, and that isn't even actually current revenue.
Wow.
So that's future-looking revenue. And this year we've seen it come right back to the mean, which tends to be for companies with strong recurring revenue, sort of 6 to 8 times. So there's been quite a big change in valuation. And a lot of companies last year that raised money at very high valuations are now having to look and say, what does this mean for my future and how am I going to raise capital in the future?
Yeah, so I was going to say that. So you're sort of two different assets here. One is that people looking for money now that venture capitalists might invest in for the first time. But then there's also all these other smaller businesses that are listed on the ASX, things like clinical trials platform HealthMatch, Wine Collective, which is an online retailer, Booktopia, which is an ASX-listed bookseller. They have to rethink their models a bit too, because they have raised money over recent years at higher valuations. How does that affect them?
Look, I think a lot of businesses are having to start to become much more capital efficient than what they might have been a year ago, because it will be a harder capital raising market moving forward. So people are starting to look at their areas of business. Where can they save costs? Can they stop some areas that are non-core activities? Can they also analyse their sales rep performance and see whether there's some staff that aren't performing as well as others, and maybe they're going to, cut some staff across the business to make the company more efficient. So that'll extend their capital runway and allow them to grow their business before they actually go back and seek future capital.
In many ways, I mean, no one likes to see a business underperform, and for the individuals, obviously, it's dreadful. But in a sense, it's not a bad thing for the market for people to be forced to be more efficient in their use of capital.
That's correct. And I think ultimately it means there's going to be better value for investors. So last year it was actually quite expensive from an equity, it was cheap for the companies to raise equity, but from an investor point of view, it's quite expensive. Now we've almost got the reverse happening. For a company, equity is becoming more expensive, but for investors, it's becoming cheaper for us to invest.
Okay, so Michelle, what's that mean for venture capitalists like yourself, like OneVentures? Are there greater opportunities in this sort of environment, or how does that play out?
Yeah, I definitely think over the next 12 to 18 months, there's going to be more opportunity to come into very high quality companies, but to do it at much more attractive valuations. So I think this bodes very well for the sector. If a fund manager has capital at the moment, it's a very good time to have capital. And what we would actually say is that it'll probably produce a very good vintage fund in the future.
A good vintage fund, what does that mean exactly?
Well, that means that in this period is going to be quite good investing, and hopefully the markets will improve by the time you come to exit a company.
Like the 98 Grange, the 2022 VC investment, that sort of thing.
Exactly.
Righto. Actually, I've got to add, I have no idea whether 98 Grange was any good or not. I made that up. So before a listener jumps in here, I have no idea. Stay with me, Michelle. We'll be back in a minute. I'm speaking to Dr Michelle Deaker, the founding partner and managing director of OneVentures. Where do you think the opportunities are at the moment then, if you think about investing money over the next 12 months or so? Are there sectors or, can you kind of give us a lead on that?
Look, we obviously are technology and healthcare investors, and both of those asset classes have been impacted by, this re-rating of the market. And that means that those classes are actually going to be quite good for investing into. So we were actually trying to sell some of our asset positions last year, and we managed to do that quite successfully at the peak of the market. And right now we'll be looking to invest, and hopefully some entrepreneurs will be starting to reset and recalibrate what, their companies are worth, because they've come out of a period where they've been able to almost ask for what they wanted for their companies because there was so much capital chasing investment. And now there's much less capital chasing investment. In fact, there's a capital crunch that'll be coming next year, and we can talk a bit more about that. But we will find in technology and healthcare, there's very good investing, both in the listed and unlisted markets.
So if you talk to an equity investor as opposed to a VC investor, in healthcare and technology, they say strong balance sheet, make sure they're making a profit, go nowhere near companies that aren't making money at the moment. Whereas a VC, you'd have a different view, I'd imagine, on the technology and healthcare sectors.
We do. So first of all, in healthcare, you don't often find, particularly in the biotech segment, companies actually making much money because they're going through clinical trial processes to develop the next drug or the next device that's going to, change healthcare outcomes for patients. So the fundamentals of those businesses often haven't changed, but it's actually looking at and understanding the risk and regulatory profiles of those businesses that determine how we invest in them. On the tech side, we are looking for companies to have a pathway to cash flow positive if they need to, but not necessarily needing to be cash flow positive, because we like them to invest in sales and marketing growth, but not growth at all cost. So last year we would have said everyone was chasing growth no matter what the cost. Now we're actually looking, saying we want to see really strong fundamental unit economics for these companies. And it is sort of moving forward with growth, but doing it in a more measured way with an understanding of the path to profitability.
You mentioned capital crunch. Tell me about that.
So in the institutional market, so these are the big global pension funds, they think about their asset allocations. And last year, a lot of venture and private equity fund managers were raising money. And because the market was very hot, they had placed all their 2022 capital by the 1st of January this year.
Ouch.
And they'd already allocated their 2023 capital by the middle of this year. So that means there's going to be no new capital from these big institutional investors into fund managers until about 2024. So even though a lot of managers have raised money and they'll be able to invest that money, all the managers are sitting there looking and saying, but we might not be able to raise new funds again until 24. And what does that mean? That means we have to reserve more capital for our existing portfolio companies. And that means we're going to have less capital to invest in new deals.
Which is good for you guys then.
Well, it's good for us because it means we're going to be able to be very selective.
Yeah.
But for the underlying startup community, it means there's probably going to be less available capital than there has been.
Yeah. Okay. Just finally, before I let you go, we have spoken so much about ESG on Fear and Greed over the past couple of years, though in the last 6 months, other factors seem to have sort of pushed off away from the headlines a little bit. In technology and healthcare particularly, because we don't think about those areas in terms of ESG anywhere near as much as we do, energy and resources and things like that. How big a focus is ESG in tech and healthcare? And is there a premium for companies who consider those ESG factors more so than others?
Look, ultimately, really amazing companies that do more for the globe, people, purpose and planet, as they say, than other companies, probably have a stronger mission and so are likely to outperform. And if they get their ESG metrics right, they're probably likely to outperform. So in that sense, could you say there's a premium for those types of companies? I would say there could be, because they're probably addressing a really large global market need and problem. So we have a company called Vaxxus, and it's developing a patch for vaccination. We went through the pandemic and saw how costly it was to, try and vaccinate people. And, you needed nurses and you needed all that cold storage infrastructure. All those problems Vaxxus solves. So it has great outcomes for, people and a great purpose. So that company is obviously really forging ahead and an amazing business. So I think you can get that as well.
Michelle, thank you for talking to Fear and Greed.
Thank you very much. Thanks for your time, Sean.
That was Dr Michelle Deaker, the founding partner and managing director of OneVentures. This is the Fear and Greed Daily Interview. Remember, you should get professional advice before making any investment decisions. Join us every morning for the full episode of Fear and Greed, Australia's most popular business podcast. I'm Sean Aylmer. Enjoy your day.